Hey guys, Toby Mathis here. And unless you've been living under a rock, you've probably heard about GameStop and all the stuff that's gone on Wall Street. So I wanted to just kind of break it down for our folks and to get you our take on it so you understand what's actually going on, what's real versus what's kind of the fake news that's out there, using a term from politics. So number one, what is all the hubbub about with these companies, Nokia, BlackBerry, GameStop, all that's going on? So I'm going to use GameStop as an example. Kind of a beleaguered retail uh, business that's been losing money. It was right around $18 at the beginning of the month. Runs up to almost 400 bucks. I think it was probably 375 around its high, but it just had a huge push, and there was a reason for it. It was because some hedge funds decided to short the stock, and some the trading communities, basically some folks on Reddit, Wall Street Bets, started to rally around it and said, "Hey, we're not going to let the hedge funds make money, uh, taking advantage of the bad things that are happening to GameStop." And so I'll put it into little pieces so it makes sense. Number one, shorting a stock is nothing more than borrowing it so you can sell it with the promise to replace that share at a set time in the future. So if a stock is trading at $20 and I borrow it from you and I sell it, I now have $20 in my pocket, but I have to replace that share at some point. So I'm going to have to buy it back. If the stock goes down, I'm buying it back and keeping the difference. So if that stock goes down to $10, I buy it back at $10. I give you your share back, and I made $20. It cost me another 10, so I pocket the difference in the $10. It's called shorting a stock. So if you remember the Big Short with Christian Bale, when they were talking about shorting the market before the big collapse in 2008, when the mortgage industry went, that's what they were doing. They were borrowing shares so they could sell them, take the money now, and then replace it later on in the future when those things go down. And that's the idea of shorting, is you're predicting that it's going to go down. It's really risky. Me personally, I think it's kind of manipulative because these big funds get out there and kind of with their buddies, and they're going to talk some smack about a company and try to force it down. And it's going to benefit them doing it. Not necessarily fair, right? So think back when this pandemic started and you saw people going out there talking, hey, Hilton could go to zero and the airlines are all going to go bankrupt. What were they doing? Well, most likely they were shorting those positions and then forcing the runoff so people sell it, and it pushes it down. So there's that side to it. So what happened is there was a bunch of short positions on GameStop. They're thinking this is going to go down. Let's push it down. So somebody had it. And again, I'm not looking at the exact numbers. Let's say it was 18 bucks. So now they're going to have to cover that position. So somebody borrowed the stock, they sold it, and now they're going to have to cover by buying that stock back at a later time. Enter Reddit and the internet and Twitterverse, Wall Street Bets. All these guys go out there and start saying, buy GameStop, jam it up, don't sell it. And so the laws of supply and demand, what's going to happen when nobody's selling and everybody's buying? Price is going to go up. So it jumped up and went over 300 bucks. So you had all these people now basically forcing the hedge fund to buy back the shares that they sold. So the hedge fund sold it, let's say, again, I'll use $18 as an example. Let's say they sold it at 18. I don't know the exact number that they borrowed it, so I don't know, but let's just say it's 18 bucks, and they're going to have to buy that share back at $300 to cover. So they're going to lose, in that scenario, $282 per share. They're going to have to come up with money, which is exactly what happened to a large hedge fund. They pretty much, almost put it under. They had to go raise a bunch of emergency cash. So then you say, all right, so we're basically bidding it up. The company is really not worth that in technical terms, but then again, Wall Street's kind of this emotional creature. What's a company really worth? Who knows? You have companies losing money that are worth, $1 trillion. You have companies that make money all the time that are worth less, right? There's no rhyme or reason to it. It's just whatever those shares will be sold for. So you had GameStop get jammed up and people saying, hey, there's no way it's going to stay there. There's no way it's worth that. And then you had some of the platforms like Robinhood say you could not buy it anymore. You could only sell it. And people started screaming collusion. They're doing this for the clearinghouse. It's Citadel, and they're forcing them to do it. And then TD Ameritrade came along and did the same thing, and some others. And they basically said, hey, we're going to restrict your ability to buy this company, but you can certainly sell it. And there was a couple things going on. First off, you could think it's criminal activity. They're colluding. They're trying to help the hedge funds. The hedge funds have to cover. So by only allowing selling, what will that do? Nobody can buy it. So it's just sellers. So the price will go down. So in theory, it's helping the hedge funds. But in reality, there may be other things going on. Like we'll know in the future. But my guess is usually when you sell a stock, you have 2 days. When you buy a stock, you have 2 days to clear, which means it's basically almost like a loan. You're going to have to be liquid. There's all these regulations and rules to make sure that trading platforms don't go out of business. And so if they have a whole bunch of activity and they have to clear, they're going to have a whole bunch of cash on hand for those shares because they're going to have to. It's almost like 2 days where there's a little bit of a float there where they're on the hook and they got to make sure they have liquidity requirements. I wonder if that's what's taking place. So I'm speculating, but my guess is that there's some of that going on, and there's a ton of volatility, and there might be some favors being called in. So you're going to hear it on both sides. You're going to people saying, "Hey, we're protecting investors from themselves because these companies aren't worth what they're paying it, and they're going to get really hurt when everybody dumps it after it goes on this run up. Everybody's going to sell it. It's going to crash, and all these poor retail investors got hurt. And let's ignore the fact that the big hedge funds lost billions of dollars. Like that couldn't be the reason, right? Or you're going to see some people coming out saying, hey, Robinhood was going to become illiquid. They had to go raise some emergency cash so that they could cover these positions. And then you're going to have other people saying they're colluding, it's criminal, and it's all a big cabal, and they're trying to hose the little guy, and it's retail versus Wall Street traders and the retail investor. These guys that were on the internet are going to get hosed, and the rules are changing, and all that stuff. You're going to hear it all. My philosophy is really simple. I don't bet. I don't gamble. I don't think anybody should be gambling unless they can afford to lose the money. If you want to gamble a little bit, go for it, but don't gamble the money that you live on. In other words, if you need the money, don't gamble. Put it in companies that pay you, that make good money, and they pay you out on a consistent basis. Look at the dividend kings, the dividend aristocrats, companies that have been paying dividends 10 years, 20 years, 25 years, 50 years. Don't go with this newfangled companies that don't actually make money and you're just hoping they go up in value. That's a recipe for disaster on somebody who is trying to live off of the income that's being generated in the market or is going to be retiring off that money. So make sure that you're looking at companies where they can't play this game and try to avoid the Wall Street casino if you can, unless you really want to gamble, in which case make sure it's money you can afford to lose. It's not your rent money, right? It has to be things that you can afford to lose if you want to go play some speculative. Otherwise, buy companies that are solid and that are paying out a decent return, whether it be a 3%, 4%, 5%, 6% dividend. If you can get a good company that consistently raises that dividend and then just hold it forever, buy it with the intent that you're not going to sell it, that it's an income generator, and then sit back and let it appreciate, let the dividend grow every year. 10 years from now, you're going to look back and you're going to have twice as much money as you started out with, and you're going to be getting this nice payment coming in, and it's going to continue to compound, and you're going to do better and better and better over time. Do that instead of playing the gamble. But now you understand that there are some things out there that are very speculative, that shorting is the great example. Borrowing something, selling it, and then buying its replacement at a later date, that's shorting. And what the retailers did is what's called a short squeeze, which means they bid up that price, made the company more expensive so that the buyback was greater than the original sell. So I borrowed something, sold it for a lot less than I ended up having to replace it for. Kind of think of it like this. I borrowed my neighbor's lawnmower, sold it for $200, thinking that I could go buy a replacement for 100. And then I went to the hardware store and the replacement was 500. So I sold it for 200. Now the replacement's going to cost me 500. I'm going to do really, really bad. If the replacement was 100, that's great. I buy the replacement, give it to my neighbor, and I pocket $100 and go get myself a new lawnmower. Right? That's it in a nutshell. That's what was going on. That's all the craziness. Expect to see more of it as these guys lock horns and do Battle of Wall Street. I would say watch it, be a spectator, don't jump into the fray.